Okay, so what we are going to discuss tonight is Singapore REITs. It is a topic that we have seen some of the members in the Beansprout community asking us about. I myself, as a REIT holder, have been wondering why the prices have been coming off over the past few months. So hopefully from tonight's session, we'll be able to update ourselves around what are some of the key developments of the REITs and what we can do to equip ourselves going forward. Okay, so just before we start, today's sharing is for information purposes only. It should not be taken to be financial advice, okay? So if you actually agree with this, can I just get your help to be able to type in yes in the meeting chat so that we are in agreement that this is for information purposes only, even though I'll be using some illustration on some of the REITs to be able to go through with everyone who is on the call today. Okay, thank you. Next, for those who might not be familiar with myself and Beansprout, maybe just to give you a bit of an introduction. So my name is Gerald. I'm the founder of Beansprout, and we are a financial platform that helps you to make better financial decisions. So you probably have come across some of our content, whether is it on the REIT analysis, maybe come across some of our REIT tools. We also share insights on, say, how do you compare T-bills with fixed deposits? How do you compare fixed deposits versus REITs? So hopefully those will be some of the insights that'll be helpful for you to be making financial decisions. If you find that helpful, do visit our website or join our different social media channels where you'll be able to get more updates. Okay, so a few things that we'll discuss tonight. So number one, before we even try to understand how REITs will perform going forward, we'll try to understand what is driving the weakness in their share price. Next, we will actually look sector by sector to actually understand what are the fundamentals of the different REIT subsectors that you might be interested in. And then last but not least, we will actually think about what are the things to look out for that can potentially affect the prices of REITs going forward. Okay, so first and foremost, let us try to understand where are we today. So if you look at this chart, effectively what you see is that the performance of Singapore REITs have been fairly weak so far this year. Effectively in November and December last year, we already started to see a bit of a recovery. Okay, so by the time we were coming into the new year, the share price of the Singapore REITs were back to where they were in August. But if I were to look at the performance so far this year, it has been pretty dismal, where we see that if I were to look at the IHS REIT index, which is the benchmark of a portfolio of different REITs, then what we see is that they have effectively come down by about 10% so far this year. Okay, so different REITs have been impacted to a different extent, really depending on the exposure that they might have and whether they are able to still pay out attractive dividend to shareholders. But I think more broadly, the key reason for why the REITs have been performing poorly is down to really this expectation on interest rates. Okay, so if anyone were to ask what is the key reason the REITs have been weak, I would come back to this chart, which is around inflation, which effectively shows that what we have is that you have the CPI in the US actually being above expectations. Okay, so what we saw in the month of March is that inflation appears to be a bit more persistent than expected. The US Consumer Price Index rose by 3.5% in March compared to the previous year. This was actually higher than what the economists were expecting. If you look over the past 3 months, it is also becoming more of an upward trend after having this steady decline in the second half of 2023. Okay, so if you were to look back in, say, October last year, when the CPI data came down to just above 3%, I think a lot of investors were expecting that, okay, we might have seen the worst of the inflation. Then I guess when the data came in through in January this year, it was above expectations, but because it was just a month of data, maybe some investors just brushed it aside on the expectation that the Fed might actually still continue with its interest rates cuts going forward. The number in February came in above expectations again, and then in March, the number again was above expectations. So what is this actually leading to is that previously a lot of investors were expecting that we'll start to see interest rate cuts this year. But what has effectively changed is that with the persistent inflation, investors are now expecting that the Fed will actually slow down on its interest rate cuts. Okay, so this is something that I am able to see based on the probability of the interest rate cuts. Okay, I've just used an example here, which is the upcoming Fed meeting in June. Okay, looking at the 12 June 2024 Fed meeting. So effectively, the Fed is the US central bank. A lot of their interest rate direction would effectively be impacting global financial markets, and it has also an impact on the interest rates in Singapore. Okay, so what we see here is that if I were to look at just 1 month ago, okay, on the 22nd of March, there was more than a 60% probability that investors were expecting the Fed will actually cut interest rates in June this year. Okay, but if I were to look at the current expectations, okay, which is the dark blue column, what we actually see here is that after the recent inflation data, investors are now expecting that the Fed will keep interest rates unchanged in the June meeting. Okay, so in other words, we might not actually see such a rapid pace of interest rate cuts, which is why the general term that a lot of investors use is that interest rates may remain higher for longer. Okay, so what this effectively means is that compared to expectations that interest rates might be cut very quickly, what is the current expectation now is that interest rates may actually stay high for an extended period of time. Okay, so this is effectively what we see for the US government bond yield. Okay, so how does that reflect different financial markets and different assets? First and foremost, we can see this very significant impact, which is on US government bond yields. Okay, because the expectation is now that the Fed won't cut interest rates as quickly. We have seen a very big jump in the US government bond yield. Most investors look at the 2-year government bond yield for an indication of the Fed interest rate direction. And what we see here is that if I were to look at the start of the year, it was at about 4.1%. Okay, just within a few months, it has climbed up to close to 5%. Okay, and 5% is a level that many investors actually keep a lookout for because of the fact that it has been a level that actually indicates to us what kind of returns an investor in a 2-year US government bond yield would actually receive. And if the bond yield actually exceeds 5%, it means that most other assets which might not generate such a good return and in such a risk-free way compared to the US government bond yield might then not appear as attractive. Okay. We can also look at the US 10-year government bond yield. We also see a very sharp increase in the US 10-year government bond yield. Okay, so if I were to look at the start of the year, it was at about 3.8%. Okay, but when I just checked and updated this chart, we are now at 4.6%. Okay, so also a very significant jump in terms of the US 10-year government bond yield as a result of the persistent inflation that we saw, as well as the expectation that the Fed might actually not cut interest rates so quickly. Okay. So how does this interest rate expectation impact Singapore REITs? Okay, so we need to understand how these higher interest rates might potentially affect Singapore REITs. And there are three ways that this can have an impact, okay? I think the first one would probably be what most investors here might be aware of, in that, number one, because interest rates are higher, that can potentially lead to higher financing costs for the REITs. And if they are not able to generate a higher rental income to be able to offset that, it will then lead to lower distributions for the REIT. Okay, so I think this is the most straightforward mechanism that some of us here might be aware of, and we are going to track very closely in terms of which are the REITs that can have a higher financing cost, and then as a result will impact their distributions. Okay. The second point might be something that we do not think about as much, but can also have an impact on the REIT, which is that if you think about the REIT, effectively they own different property assets, whether is it office buildings, whether is it a retail mall, and the valuation of these property assets are actually tied to the entire interest rate environment, okay? So if the interest rate is actually low, this actually sets up a more favorable environment for the valuation of the property asset. But as the interest rates actually go up, then the valuer of the property asset might actually have to reevaluate whether that might actually lead to a lower valuation of the property asset. Okay, so that is something that we also need to keep a lookout for, as to whether the higher interest rates lead to a lower valuation for some of these property assets that are owned by the REITs. The third point is actually more from a capital allocation perspective. So if we actually have a relatively risk-free asset, such as the government bond offering a more attractive interest rate, like what we have seen for, say, the Treasury bill or the Singapore savings bond, what some investors might do is that because you have maybe the Singapore savings bond offering you average 10-year return of above 3%, then in that case, maybe the dividend yield offered by the REITs might not look so attractive to you, in which some investors might decide to sell their REITs and put their money into Singapore savings bonds instead. Okay, so as the interest rate or yield being offered by some of these lower risk assets actually go up, then effectively what the REITs will need to offer is a higher dividend yield to be able to make them more attractive to investors. Okay, so that is effectively why the share price of Singapore REITs have come down, really as a result of the persistent inflation that we have seen, and thereby impacting the REITs in these three different ways. Okay, so we have actually done a quick recap around what is driving the weakness in the REIT prices. So at this point in time, before I go on to discuss about the different subsectors, I just want to do a short quiz. Okay, so earlier I shared how higher interest rates can potentially affect the REITs. So I just want to get your answers here. How do they affect the REITs? Put your answer into the chat box, and then we can have a discussion if we see that it might be something that we need more explanation towards, or if you have any questions around how the REITs can be impacted. Okay, so number one, REITs have higher financing costs. Yes, we see that coming through, especially if they do not have their debt actually fixed at a certain interest rate, or they actually have a very high level of borrowings, then the higher interest rates can potentially lead to higher financing costs. Okay, the value of the properties owned by the REITs may decline because one of the factors that affect the valuation of the properties will be the interest rate. So as the interest rates go up, the valuation of the properties may actually come down. Thirdly, we see that as some of the other assets become more attractive, say if the Singapore savings bonds now offer a higher yield, then for some investors, they might actually choose to invest in the Singapore savings bonds rather than in REITs. Okay, so the answer is 4. I see that most of you actually managed to give us the answer, which is all of the above, in that higher interest rates affect the REITs in many different ways, and that's what we have seen actually being reflected in the share prices of the REITs. Okay, so having done a quick recap, next we are going to have a view on what is coming up for the Singapore REITs and how the different subsectors are actually performing. Okay, so at this point in time, I just wanted to share what we typically use at Beansprout as our investing checklist on the Singapore REITs. I've tried to break it down into 3 simple points so that it is something that you can constantly refer to and be able to do your own checks if you own specific REITs as to whether they continue to meet these different factors and you are still comfortable holding on to them as part of your portfolio. Okay, so first thing, because we are wanting to invest in the REITs for a fundamental reason, okay, if you are investing based on a trading signal or for short-term reasons, then this might be a factor that you are not looking at as actively. But if you're a long-term investor looking at the REIT from a fundamental perspective, wanting to hold the REITs for their dividend, then the 2 key things that I would effectively be looking out for, number 1, the quality of the sponsor, as well as the management team. So while the REIT is actually composed of property assets, we must also be mindful that there are REIT managers who are actively trying to improve on the management of the REIT assets. They are trying to make acquisitions, they are trying to make divestments, they are trying to actually make sure that the interest expense do not go up as much. So in this case, the REIT management also plays a part. We also see that the sponsor does play a part because the sponsor can effectively come in to divest assets towards the REITs, or in cases where there might be a need to support the REIT in different initiatives, a strong sponsor can make a difference as well. The other fundamental strength that I'll be looking at would be really the tenant mix and occupancy rate. This is something you'll be able to get from, say, the company's quarterly update, from their annual report, where it provides us with some indication as to how the REIT asset is performing. Okay, so that is on the fundamental level. So the next thing I'll look at would be the financial strength of the REIT, in that it could have very good assets, but maybe the debt levels are very high, or that maybe what we see is that they have a lot of debt that might be due for expiry or renewal over the next 12 months. So that is something that we'll keep a close lookout for as well, especially if interest rates were to stay high for an extended period of time. Last but not least, I will also look at it from a valuation perspective, because it can be a REIT with a good asset, it can be a REIT with a very strong balance sheet, but if the REIT is already trading a very expensive valuation, either from a price to net asset valuation perspective, or from the fact that maybe it doesn't offer such an attractive dividend yield, then I would potentially consider whether there might be other REITs that might be more suited for my portfolio. Okay, so in a nutshell, those are the 3 key things. Number 1, fundamental strength, 2, financial strength, and 3, valuation, which are the key things I'll keep a lookout for when thinking about investing in REITs. Okay, so I shared that the fundamentals is the first thing that I will keep a lookout for. So in terms of fundamentals, what we want is for the REIT to be able to earn good rental income. And one of the things that we always keep a lookout for is whether they are able to generate higher rents versus the previous year. Okay, so if they're able to generate higher rents, what this typically means is that for the same asset that they have, okay, they are then able to have a higher net property income. And if the interest expense does not go up by too much, if there's not too much of, say, foreign currency impact that will affect their Singapore dollar distributions, then the dividends that are paid out to unit holders would potentially be higher. Okay, so first and foremost, we want them to be making a higher rent for their property assets. So what we see here is that while the interest rate environment has not been favorable, in terms of the fundamentals, we actually still see fairly healthy rents for the REITs. Okay, so whether is it across office, retail, or industrial assets, in the 2023 and going to early 2024, we are still seeing that they are able to generate positive rental growth for their assets, okay? And across, say, retail, office, and industrial, they have all been in the range of positive 5 to 10%. So I guess in the first place, something that we can think about is that, okay, in terms of the fundamentals, actually, it is not as bad as what the share price might actually suggest, because in terms of the rents, they are actually still able to generate positive rental growth for some of their, say, retail, office, or industrial assets, okay? Okay, and if I were to look across this, just off the top of what I see here, retail has been the one that is a bit more resilient, okay? So on an upward trend towards the second half of 2023, we'll go in further detail to understand what is driving each of these subsectors later. But at least from a first look from this chart, retail appears to be the strongest subsector. What we see here is that industrial was very strong in the first half of 2023, but is starting to moderate into the second half of 2023, okay? Office has also had a good recovery in 2022 and 2023, but the recovery is a bit more muted compared to what we see for industrial as well as for retail, okay? So that is something that we can actually pick up from this chart based on the three major subsectors of the different REITs. Okay, so generally for REITs, we have different subsectors. We have got retail, hospitality, office, and industrial. I will go into each of this in a bit more detail. But before I do that, maybe I'll just get some indication from the participants tonight. We have 4 subsectors here. Is there one subsector that you are more interested in? And then maybe I'll spend a bit more time going into the subsector. So A for retail, B for hospitality, C for office, and D for industrial. You can put in the chat, and then when I'm going through the outlook later, I will spend a bit more time on these subsectors. Okay, so I see some responses. I see hospitality, retail, all of the above. Okay, so effectively I need to go through everything since the responses are quite mixed. I was expecting that there'll be more interest in actually retail and hospitality, since those are sectors that are what we typically see and feel more often. But I also see that people are interested in office and industrial, so I will touch about these subsectors in the subsequent slides as well. Okay, so I start with retail since it's something that is a bit closer to our heart and it's something that we can relate to a bit more closely to. So in terms of what we see for retail, first and foremost, for the retail malls to be able to do well, people need to spend. So the first indicator I'll look at will be the retail sales, okay? So the good thing is that the Singapore government actually releases this retail sales data on a monthly basis. So I'll put out the data for February, okay, and try to get an indication on what are the trends in retail, whether is it still something that is doing well or not. Okay, if you recall, February was the Chinese New Year month. So we saw very healthy growth in the retail sales. Even if you were to ship out the sales of motor vehicles, it is still growing about 8.4% year-on-year or 3% month-on-month, okay? So retail has actually been doing fairly well. And we see this especially for some of the more discretionary kind of spending, where actually with the tourists actually starting to come back to Singapore, that has actually provided a lift to some of the retail sales numbers, okay? But this is the February data, okay? So remember that there was the Chinese New Year impact in there. But we have still not seen, say, the full extent of some of the tourism recovery. So as a whole, we see that the retail sales has been fairly healthy across quite a number of different segments within retail in itself. Okay, so if I were to look at one of the specific REITs, I've used CICT or CapitaLand Integrated Commercial Trust here as an example. The numbers do get reflected in their tenant sales and shopper traffic as well. Okay, so for those of you who might not be familiar with CICT, I use this as a benchmark because they own so many of the retail malls in Singapore, both downtown as well as in the suburban areas. Okay, so downtown would be, say, as an example, Plaza Singapura. Okay, so that would effectively be a mall that would be more driven by the tourist recovery. And then some of the suburban malls might actually be driven by what you and I might buy in terms of the groceries. And it has actually been a lot more resilient. Okay, so what we see here is that across the retail portfolio, tenant sales was up. The suburban malls is holding up well with 3.1% year-on-year growth. Downtown malls actually increasing by 1.7% year-on-year. Okay, and this for the entire of the first quarter of 2024. If I were to look at the shopper traffic, okay, so effectively the footfall that goes through the malls rather than the spending, this is where the downtown malls are actually doing a lot better together with the recovery in tourism. Okay, so overall, this is quite consistent with what we saw in terms of the retail sales numbers in Singapore, where because of the resilient domestic spending, because of the recovery in tourist arrivals, the tenant sales as well as the shopper traffic has been improving. Okay, so likewise, this is what we see in terms of the rents, both at Orchard Road as well as in suburban areas. Okay, suburban rents here refer to some of the heartland malls, whether it is like at Bedok, Tampines, Jurong East, those will all be considered the suburban malls. But what we see here is that there has been a fairly consistent recovery post-COVID. Okay, the suburban malls were the first ones to recover because of the fact that we were actually going back to work. We were no longer actually just at home during the lockdown. So we saw the recovery in the suburban rents first. And then as the tourists started to recover, we started to see that the shopper traffic at the Orchard Road Mall started to improve. And with time, the malls that are at Orchard Road are able to enjoy a higher rent as well. Okay, so that is what you see here in that in 2021, some of the Orchard Road malls were still facing negative rental growth. It then turned flat into 2022, and in the second half of 2023, the recovery actually accelerated. Okay, if I were to look at the suburban malls, it had a strong recovery post-COVID, okay, doing much better than the Orchard Road malls. But then in the second half of 2023, the pace of growth in the Orchard Road malls have actually exceeded the suburban malls, okay? So, but overall, still healthy across both the Orchard Road malls as well as the suburban malls. Okay, next we look at hotels, and this is something that is reflecting the recovery in the global travel industry. We see that the tourist arrivals has actually reached a post-COVID high in the month of March. So that is actually helping to support the demand for hotels in Singapore as well as the retail sector. Okay, so if I was to look at, say, the latest tourist arrivals, just above 1.4 million, okay, the highest level since 2020. But it is actually still slightly lower than some of the better months in 2019. And that is really because we have not seen Chinese tourists arriving back in full force as yet. And that is why, in terms of the expectations by the Singapore Tourism Board on how many tourists they expect in Singapore this year, it is still slightly below where it was prior to COVID. Okay, but even though the number of tourists has not actually recovered to pre-COVID levels, what we have seen here is that for hotels, the average revenue per available room is already above the pre-COVID level. Okay, so if you are not sure what this hotel RevPAR actually means, okay, it is actually the revenue per available room. And it is a combination of two things. Number one, the room occupancy rate. And number two, what is the average room rate? Okay. So for example, you can charge a very high room rate. You can raise it to $500 per day. But then if your occupancy is very low, you will still end up with a fairly low revenue per available room. Okay. So the manager of the hotel asset will need to find a good balance in terms of being able to get a good average room rate and also getting a good occupancy rate. But what we see here is that in general, the RevPAR has actually recovered by 2023 to be above where it was prior to COVID. Okay, so as we continue to see the tourists coming back to Singapore, one of the key concerns that some investors might have is that, whether we will see a very big growth in hotel supplies, such that even with the tourist arrivals into Singapore, it is actually not able to offset that. The good news here is that there is fairly muted growth in new hotel supply in the Singapore market, because a lot of the investors have not been putting money into new hotel assets over the last few years. And what this means is that if the tourist arrival numbers continue to grow, given that the supply of hotel rooms in Singapore is not expected to grow very strongly, then what we might see is a continued expansion in the revenue per available room that the asset owners are able to generate. Okay, next we go to office. So in office in particular, we look at what are the office rents that asset owner is able to generate for some of the downtown office space. And what we see here is that the recovery has also been ongoing since 2021. Okay, so the rents actually came down because of COVID. Prior to that, it reached a high of about $11.55. This is charged on per square foot per month. Okay. Then because of COVID-19, there were the concerns that a lot of people will work from home. We were not going back into office as much. A lot of companies slowed down on their expansion plan. So the rents actually came down to about $10.40. But in 2021, we have started to see the recovery. Okay, the recovery was a lot stronger in 2021 and 2022, and then it started to moderate in 2023, and that has actually continued into the first quarter of 2024. Okay, so what we see in the past few quarters is that it's been increasing by about 0.4% per quarter, such that it is now at about $11.95, above where it was in 2020, okay, but still nowhere near where it was in the previous peak. Okay, so the two key things that I'll pick up from this table is that number one, we are seeing a gradual recovery in the office rents, but at the same time, it is not a very strong recovery because of the fact that number one, while the economic growth is decent, it is not something that is booming. There are still concerns about whether we are going to see a recession. Interest rates are still at very high level. So companies would not be expanding very aggressively under this environment, which is why we see that the rental growth is positive, but it is not growing at a very fast pace. Okay, and if you were to look at the office supply in the upcoming years, earlier we saw that in terms of the hotel supply, it is not something that is growing too quickly. But if you look at the office supply, it is actually something that is growing a bit faster. So we actually have got an addition, 1.3 million square feet of office space that is going to be completed this year, another 1 million square foot in 2025. And what this means is that over the next 3 years on average, it will grow at about 0.8 million square foot per year, which is above the historical average. Okay, so that is another potential headwind for office space, because while demand is growing at a steady pace, you actually have this increase in supply that's coming up over the next 1 to 2 years. Okay, last but not least, I'll just touch briefly on industrial. So we saw earlier that industrial rents actually recovered very strongly in 2022 and 2023. If you recall, that was really driven by the demand post-COVID because there were supply chain bottlenecks. Companies became more aware of how important it is to build up their logistics network. Because of the boom in e-commerce, there was a lot of additional demand that came through from warehousing and other requirements because of the increase in e-commerce demand. So that actually led to the very strong boom in 2022 and in the early part of 2023. But that is also starting to moderate slightly. Number one, because the economy is starting to see some form of weakness in selected sectors. Particularly, say, the manufacturing sector, the export sector has been very weak. So that has actually started to impact some of this demand for industrial and logistics space. Okay, so overall still healthy, just that we need to be mindful that we are not in the very strong growth phase, unlike in 2022 and the early part of 2023. Okay, so with that, I have covered some of the major key subsectors of the different REITs. Okay, and if you recall, the other key thing that I mentioned, I will keep a very close lookout for, is also the balance sheet of the REITs. We have looked at the fundamentals of the REITs in terms of how they are doing, in terms of the occupancy rate, the reversions. But it is also important for us to keep a lookout for the gearing level or how much borrowing the REITs actually have. Okay. Once again, this is very important because if you recall, we started by talking about how interest rates may stay higher for longer. And if interest rates were to really stay higher for longer, we want to make sure that the REITs that we own have the ability to withstand this higher interest rate environment. And one of the ways that they can do so is not to have too much borrowing. Okay, so what we see here is the level of borrowing. We start with the black bar at the top. Okay, so on average, the Singapore REITs have a gearing level of 38%. Okay, so first and foremost, if I'm looking at the REIT sector as a whole and thinking about whether I need to be concerned that they might have issues with their gearing level, on average is 38%. And this is well within the MAS limit of 50%. Okay. In some cases, if the income coverage ratio is below 2.5 times, which means that how much income they are able to generate from the property versus how much interest they need to pay for the borrowing. If they are not generating sufficient income from their property to pay for their interest expense, then what MAS would require is for them to keep their borrowing to an even lower level. Okay, so this 38% is still comfortable, even if you were to take into consideration the MAS limit of 45% for REITs with an income coverage ratio of below 2.5 times. Okay, but if I were to break it down into the different subsectors, then this is where you might notice that some sectors or some REITs might potentially be better equipped to deal with the higher interest rate environment versus the others. Okay. So if you're to look at US office as an example, this is where we have seen that some of the US office REITs have actually suspended their dividend payout because of the fact that they have a relatively high gearing level that has limited their ability to then pay out a distribution to unit holders. Okay, so that is why even if the REIT fundamentals might be healthy, we need to keep a very close lookout for their balance sheet because that might still impede their ability to pay out a distribution. Okay, if I look down the list, office is also where we have slightly higher gearing levels. Okay, so that is something that we need to be mindful of because of the fact that earlier we already saw that the rental growth has not been too strong. Plus, if they actually have a very high gearing level, that might mean that their interest expense might actually go up fairly quickly. And with that, their distributions could be impacted. Okay, next, going down the list, the EU-focused REITs are also having a relatively high gearing level, okay, compared to the rest of the other REITs. And if I were to look at the other side of where some of the REITs might be better positioned, I think retail is where some of the REITs are a bit more conservative, whether they are the retail REITs with domestic assets or with overseas assets. Generally, what we see is a lower gearing level. And what this means is that they might not be as significantly impacted by the higher interest costs. And there's less of a concern that they might actually be breaching the regulatory limit in terms of how much borrowing they can potentially have. Okay. So that's something that we want to be comfortable with to make sure that even if interest rates were to stay high, the REITs that we are holding on to will not have a very sharp decline in its distributions because of the higher financing costs, and it is not at any risk of breaching the gearing level limit. Okay, if I were to dive a bit deeper to then look at what are some of the recent trends in terms of the interest rates and gearing level, the good news so far is that while we have seen a very sharp increase in the average interest rates for the REITs in 2022 and in the early part of 2023, that increase seems to have moderated, such that in the second half of 2023, the average interest rate that the REITs are incurring has effectively stayed at 3.7%. Okay, so if the interest rates do not actually go up further, that is something that might mean that the further increase in the interest expense of the REITs might actually not be so significant. Because imagine if you are going from, say, 2% to 3% within 1 year, that can have a very significant jump in your interest costs. But as you are maybe increasing from 3.5% to 3.7%, the increase then wouldn't be as significant. The other thing that I will keep a lookout for, remember I mentioned that, okay, within the balance sheet, there are still a few things that we can keep a lookout for. The other thing is how much of the debt they have actually been able to fix at a certain interest rate, okay? So if you are actually having a mortgage, you might be familiar with this concept, whereby if you are able to fix the interest rate, then even if the cost of borrowing were to go up, you will not be impacted in the near term by it, okay? So that is something that would be positive if you have a high level of borrowing that is fixed at a certain rate. And if the interest rates were to go up further, then you won't have the immediate impact in terms of your interest expense. Okay, so that in summary would be the framework that I would use for analyzing REITs in terms of the sector fundamentals and how I would look at the balance sheet. And next, I will then share more about what are the things to look out for going forward. Okay, so if you have been following our articles, you always notice that there is a what would Beansprout do at the bottom of the article. So I'll use that same kind of framework to share how we look at the REITs today. Okay, so first and foremost, remember I have the third aspect of the REIT framework, which is around the valuation. Okay, so when we were to look at the valuation of the REITs, we can look at it from a dividend yield perspective. We can look at it from a price to book perspective. Okay, so what this price to book actually tells us is that what is the market price of the REIT, which is effectively what is the share price that it is trading at, versus what is the book value of the REIT, which is what the auditors have effectively determined to be the value of the asset. Okay, so remember, they are all property assets. It can be a shopping mall, it can be an office building, and all of these properties have a certain value that is attached to it. If it is at a discount to the book value, it means that what the market is valuing it at is actually below what the accountants have determined to be the value of the property asset. If it is above it, it means that the market investors are a bit more optimistic. They have given the value of the REIT a higher price compared to what the value of the underlying property assets are. Okay, so we can use that as a benchmark to see how optimistic or how cautious investors are in terms of valuing these property assets. Okay, so what we see here is that given the correction in the price of the REITs over the past few months, okay, the REITs are now not only trading below the historical average, but they're also trading quite below the historical average, which is what we show here as being one standard deviation below the historical average. Okay, so on average, they have been trading at about book value. And if you think about it, maybe fair in that in the long term, investors would value the REIT the same way that they would then value the underlying property assets. So on average, maybe at about 1 times price to book. Okay, so we're actually now at below 0.9 times price to book, which means that investors are valuing the REIT at a discount to what the property assets are being worth. Okay, so for investors who are thinking about opportunities, this can be something that we can look at, because if you're to look at the long-term time horizon, there are probably only certain periods of time where the REITs trade at the discount to their book value, and also a shorter period of time that they actually trade at a discount that is more than 1 standard deviation. Okay, so that is where we are at now in terms of what we see in terms of the REIT valuation. Okay, and if I were to look at individual REITs, that is what we see as well. I'll put out the list of some of the larger REITs that you might be familiar with, such as CapitaLand Integrated Commercial Trust, CapitaLand Ascendas REIT. And what we see here is that across all of them, the current price to book valuation is actually at a discount to the 5-year average. Okay, and remember, this is already including the COVID period, where we were thinking that, oh, actually the REITs are trading at a very low valuation and so on. But across the 5-year average, where the large cap REITs are now, such as CapitaLand Integrated Commercial Trust, Mapletree Logistics Trust, they are trading at a range of 6% to 30% discount to their 5-year average. Okay, so within this list, CapitaLand Ascendas REIT is the one with the lowest discount to the 5-year average. It's a name that we get asked very often, and I'll use that as an example later when going through how we can look at the REITs. And the one that is trading at the largest discount to the 5-year average will be Mapletree Pan Asia Commercial Trust, followed by 𝗕𝗲𝗄𝗃 REIT, which is at about a 30% discount to its 5-year average. Okay, so what are the key things that I'll be keeping a lookout for? We know that the REITs are trading at a low price to book valuation versus the historical average. But then, as many people will start asking, oh, then is it time to buy into the REITs? Are they actually at low enough a price? Does it mean that the REITs won't go down any further? Okay, so remember we started this sharing by talking about what has driven the price of REITs lower, which is really the interest rate environment. So that is still the #1 key thing that I will keep a lookout for in terms of how they can potentially then impact the share price of the REITs. Okay, so effectively what I want to share here is a tool that I commonly use to track what is the expectation of interest rates. It is the CME Fed Watch tool. Okay, so I just updated this chart today, and this is how I will use the chart. Okay, so effectively what we see here, remember I shared earlier that there are different probability assigned to different upcoming Fed meeting as to what investors are expecting on whether they will cut the interest rates. Okay, so there is an upcoming meeting next week on the 1st of May, where investors are expecting that the Fed will keep the interest rate unchanged, 96% probability. Okay, then June meeting, remember I shared earlier, just 1 month ago, investors were expecting that the first rate cut will come through in June. But at this point in time, investors are expecting that even in the June meeting, the interest rate will remain unchanged. Likewise, for the July meeting, where more than 50% probability that interest rates will be kept at the current level. Okay, based on current expectations, the first rate cut will likely be in September. Okay, And then we might see another rate cut in the December meeting, which means that we will actually see 2 potential rate cuts this year. Okay, but this is something that is at this point in time, it is still subject to change. Okay, at the start of the year, we started with expectation that there will be 7 interest rate cuts in 2024. Now, the expectation is that there might be 2 rate cuts, with the first one happening in September. But it is still something that is subject to change. And if you want to constantly keep yourself updated on what the latest expectations are, we have shared the link, okay, that you can copy down and actually just constantly check to see what are the latest expectations of interest rates for the upcoming months, okay? So whether you're a T-bill investor, Singapore savings bond investor, looking at REITs, Singapore banks, this is always a tool that might be helpful, okay? We have left the link in the chat. If you have actually seen it, if you want to copy that down, maybe you can just leave us a message in the chat as well to say that you have actually seen it, and then I'll move on to the next thing that I'll keep a close lookout for. Okay, I see a thumbs up. So Kenneth have actually seen the link. If you want, you can copy that down and just keep yourself updated on it, because I won't be doing this webinar every night and the interest rates are moving around quite sharply. Okay, the next thing that I will do is to compare the dividend yield that I'm able to get on the REITs and compare that to other asset classes. Okay, so remember earlier I shared that higher interest rates might affect the REITs in different ways, and one of the ways is that, oh, some investors might find Singapore savings bonds more attractive, some investors might find T-bills more attractive. And what we see here is that given that the REITs have actually corrected very significantly, the average dividend yield of the large cap REITs is now at 6.2%. And that is higher than what we see for the latest 6-month T-bill, is higher than some of the cash management account, it is higher than what you might get for the best fixed deposit rate, and higher for the current issuance of the Singapore savings bond. Okay, so what you need to see here is what is the difference in the dividend yield that you're able to get on the REITs versus the yield that you're able to get on some of these assets, and whether is it worthwhile for you to take maybe that amount of risk to buy into the REITs rather than some of these assets that you might find can potentially have a lower risk involved. Okay, so maybe if the T-bill yield is at 3.75%, then you might find that, okay, for 6.2%, do I want the additional 2.5%? And is it worthwhile then taking the risk in terms of buying the REITs at this point in time? Or I want to be putting my money in something that is potentially more safe, like the T-bill. Or if I find that, okay, this difference between the 6.2% and the Singapore savings bond is actually wide enough, then I might actually consider investing in the REITs versus the Singapore savings bond, just to be able to get a higher yield compared to some of these other assets. Okay, so this is something that I will also keep a very close lookout for. Apart from, say, the CME interest rate expectations, I want to know what is the latest T-bill yield. I want to know what's the best fixed deposit rate. I want to know what's the latest SSB rate and be able to compare. So if you want to be able to do this, we have a live tool on the Beansprout website. And once again, we have shared that in the chat. If you want, you can copy down this link because this is something that you will be able to get the live data on in terms of the latest dividend yield for the REITs, what's the latest T-bill yield, the latest cash management account yield, the best fixed deposit rate, and the latest SSB interest rate. Okay, so once again, if you have copied this down, maybe you can let us know as well, then I can move on to the next tool that I will be sharing and how I'll continue to keep a lookout for the REITs. Okay, if you have, actually, can you maybe just give an indication in the chat by putting a thumbs up or yes? Okay, so Dylan has shared, okay, Gilbert as well. So I'll move on to the next thing that I'll keep a lookout for. Okay, so I'll go back to this checklist. I think it's something that we can constantly keep a lookout for to understand how different REITs are going to perform in different interest rate environment. And I always go back to these three key factors, which is around the fundamental strength, the financial strength, as well as the valuation. Okay, so your next question is, how do I actually keep track of all of this? Is there a site that I can actually be able to understand what is the latest occupancy rate of the REITs? Do I have to attend all of their AGM? Do I have to read all of their annual report? Where can I find the latest dividend yield? Which I think is a question that Ken has asked. So what I'm going to share with you is the stock tool on Beansprout, and hopefully with that, you'll be able to get some of this latest data yourself when you're doing the analysis on a REIT that you might hold or you're thinking of actually investing in. Okay, so I think a lot of people have been asking us about CapitaLand Ascendas REIT. So that is something that I will start with in terms of just looking at how I will then use the stock tool in my own analysis. Okay, so I'm going to the tool to actually then share how we can look at CapitaLand Ascendas REIT. Okay, let me just try to put that up. In the meantime, I see that there are some questions coming in. Do continue to bring in your questions, and then I'll try my best to answer them during the time that I have later. Okay, let me share my screen. Okay, so I will start by using CapitaLand Ascendas REIT as an example. So if you go to the Beansprout website, if you search for CapitaLand Ascendas REIT, you'll be able to get some of the latest statistics and also information that might help you with the analysis. Okay, you'll be able to find some of our insights here as well. Okay, so in this case, I have actually recently done a write-up on CapitaLand Ascendas REIT prior to today's session, and you can actually use that as an example to be able to reference when you're doing your own analysis. Okay, so the framework that I use is similar in terms of how I've guided everyone through earlier. Look at the occupancy rate, look at the different metrics to be able to determine how these REITs are actually performing. Okay, so this is effectively the Beansprout website. Okay, so this is an article that you'll be able to see where you can then find the latest analysis, including the portfolio occupancy if you want the work to already have been done for you in terms of how I'll use that framework to look at the fundamentals of the REIT, including the occupancy rate, the rental reversions, the debt levels, basically whatever I've shared in terms of the framework earlier. But if you want to actually look at it yourself, okay, and be able to get the most updated data, that is something that you can do on the site as well. Okay, so if you go to this CapitaLand Ascendas REIT page, okay, so we see the share price performance. Say I want to go and have an analysis of how the company has recently done. Okay, I can look at their presentation as a start to be able to understand how the recent performance has been. Okay, so effectively whatever I shared in the article earlier, you'll be able to find it in terms of the company's latest presentation information that is presented here. And if I go back to then looking at some of the key metrics that I'll be looking at, so remember I shared the framework earlier in terms of how it actually performs across the different metrics. So just as a general rule of thumb here, I would compare the latest occupancy rate with the sector average, just as a quick gauge before you do further work. So if I were to look at CapitaLand Ascendas REIT here, occupancy rate of 94.2%, so that's lower than the sector average. The gearing ratio is a bit higher than the sector average, and maybe the dividend yield might not be as high as what the sector average is, okay? If you want to then have a better understanding of the breakdown of the assets, what might be driving the lower occupancy rate, then you'll be able to see a quick snapshot around what the geographical exposure or the revenue breakdown of the REIT is. Okay, but I think what many of you might be interested in would be number one, the valuation of the REIT. Okay, so we're asking, how can I find the latest price to book valuation to determine which REIT is trading above or below the book valuation? Okay, so here we have a chart of the price to book valuation. This is updated using the live prices, where you can then see that, say, for CapitaLand Ascendas REIT, now at about 1.15 times price to book, which is in line with the historical average. So even though the share price has come down a bit over the past few months, maybe you might think that, okay, maybe I have a certain entry point, which might be that if it comes down to below 1.1 times price to book, that might be a potentially better entry point, and you can continue to observe using this data here. Okay, the next one is dividend, where if you want to see the historical dividend yield, what is their payout history like, whether is it something that's been consistent, how much dividends you would potentially have received as a shareholder of CapitaLand Ascendas REIT. You can also use the calculator that's here. But what I frequently use here is the dividend yield, okay, because I see a question by one of the participants, how can I find the REIT with a 6.2% dividend yield? Okay, so this is one of the ways that you can find, in that from here, you can see that, okay, CapitaLand Ascendas REIT, 5.9%, which is below the historical average. So once again, reinforcing maybe your idea that you might want to wait until the share price comes down a bit more before you buy into CapitaLand Ascendas REIT. Okay. If you want, you can also compare across different REITs. Okay. Because maybe if you are doing your analysis, you might want to compare one REIT versus the other. So that is where you might also want to then, say, compare CapitaLand Ascendas REIT, say maybe with Mapletree Industrial Trust, to be able to then decide which is the REIT that has better metrics across things like your dividend yield or things like the gearing level or the price to book ratio. Okay, so that is one example using CapitaLand Ascendas REIT. I'll use another example, which is CapitaLand Escort Trust. Since I think some of you have indicated interest in hospitality sector. So once again, I can do the same analysis by, say, looking at how their occupancy rate has been. Or in this case, what I will actually notice is that the assets that CapitaLand Escort Trust has is fairly diversified across different geographies. So this might be something that appeals to you or don't appeal to you. I can look at the valuation once again, now trading at 0.8 times price to book. Okay, so it's one of the REITs that is trading below the historical average. And then in terms of the dividend, consistently increasing over the last 3 years, as it's able to ride the post-COVID recovery, and now generating a dividend yield of 6.9%. Okay, so that is something that might actually interest you about CapitaLand Escort Trust. Okay, so that is effectively how I would use the stock tool, and it's something that you can constantly refer to actually refresh the latest data and get the latest updates. Okay, so I'll now go back to my slides. Okay, so effectively, you want to go through the checklist, you can constantly go back to the stock tool and get this data refreshed on a daily basis. Okay, just one last point around REIT ETFs. I think from the discussion today, maybe what you might have realized is that there are still different things that we can keep a lookout for when investing in REITs. We need to understand the interest rate environment. We have to look at the fundamentals of the REIT, the balance sheet of the REIT. If you feel that that is something that you're not comfortable with, but at the same time, you want to then be still able to gain exposure towards the REITs, one thing to consider is actually a REIT ETF. If you are not familiar with an ETF, it is an exchange-traded fund, which means that it is traded on the SGX like your REIT, but rather than buying into an individual REIT, you're buying into a portfolio of REITs, okay? So compared to, say, a unit trust, ETF is typically lower cost because it is not actively managed, okay? It is professionally managed in that there is a fund manager who is helping to do the rebalancing of the ETF portfolio, but the objective is actually not to outperform the REIT benchmark, but just to be able to get you a return that tracks the REIT benchmark. Okay, so compared to a single stock, what you get with a REIT ETF is immediate diversification, because rather than having to, say, look into office or retail or hospitality, REIT ETF would then offer you exposure by owning a basket of different REITs that would be exposed towards the different industries. Okay, so if you look at what the REIT ETFs in terms of the dividend yield, they will effectively be representing what a basket of REITs would effectively offer you. So there are 5 REIT ETFs that are listed in the Singapore market. They all offer a dividend yield of above 4%, but depending on their exposure, depending on how the REIT ETF is actually made up, some of them have pure Singapore exposure. Some of them have exposure towards REITs that are listed outside of Singapore. Then you have a different dividend yield for each of these different ETFs. Okay, so if you want more information, you can go to our website. We have an article that compares the different REIT ETFs as well. And this is something that you can consider if you want to get exposure to the REITs, but don't actually want to be picking individual REITs by yourself. Okay, so I am going to give a quick summary based on what I've shared today. Number one, what we have seen is that interest rates will continue to affect the price of the REITs, and is the key thing that I'll keep a close lookout for to understand where the price of REITs are moving next. Okay, REITs can be impacted by higher interest rates to a different extent, because as we have seen, the interest rates can impact REITs in different ways, whether is it leading to a higher interest expense, leading to potentially lower valuation for their property assets, or maybe diverting people to be selling REITs and buying other assets. Okay, and in terms of looking for REITs, I'll be looking out for those that have a strong operating performance, a healthy balance sheet, and actually give me a good dividend yield or trading below the book value. Okay, if you find that you do not want to go through the checklist to be looking at each of these things, then one of the ways to still get exposure to REITs is actually through a REIT ETF, so that you don't have to be selecting each of these REITs by yourself. Okay, and if you would like to keep updated on the REITs and so on, do join our different social media channels, which the admin will be sharing as well. We'll be sharing our analysis on the REIT, some of these latest updates on where the interest rate direction is, and you'll be able to get an update from us on these different social media channels. Okay, so with that, I will actually end tonight's session. Thanks so much for joining our webinar tonight. I hope it has been helpful in terms of helping you to understand where the REITs are at this point in time and what are some of the other things that we'll be keeping a close lookout for. I know that there are a lot of questions that we haven't been able to discuss today, so we'll definitely try to find an opportunity to be able to discuss these topics that are close to your heart in another session.